Here's a number that should break your brain a little bit. Harvard's endowment is worth more than the GDP of Iceland. Princeton makes more money off its endowment in a good year than most Fortune 500 companies make in profit. And somehow, at the same time, colleges will tell you with a straight face that they're non-profit and constantly underfunded. So which is it? Are colleges broke? Desperate institutions running on fumes and government grants? Or are they some of the most quietly profitable, ruthlessly efficient businesses in America, wearing a cardigan and pretending to be a charity? Today, we're going to open up the books on how a college actually makes money. And once you see it, you will never look at a tuition bill the same way again. Let's start with the thing everyone gets wrong first, the tuition price. If you look up a private university today, the sticker price might say something like $85,000 a year. That number is almost fictional. It's closer to a luxury car's MSRP, a number that exists mostly so the dealership can offer you a discount and make you feel good about it. Here's the trick. Colleges don't set one price. They set thousands of individual prices, one per student, based on how much they think your family can and will pay. This is a textbook economic concept called price discrimination. Charging different customers different amounts for the exact same product. Airlines do this. The person next to you on a flight paid a different amount than you did for the same seat. Colleges just found a socially acceptable way to do it and called it financial aid. They ask for your tax returns, your assets, your family situation, and out comes a custom price. Rich family, full sticker price. Middle class family, some discount. Low income, high achieving student, sometimes almost free, because that student adds prestige and diversity numbers the school desperately wants. And because a very poor family genuinely cannot pay $85,000. So charging them, that would just mean losing the customer entirely. This is why the average tuition paid is often half the listed price. The sticker price isn't there to be paid. It's there to make the discount feel enormous, and to set an anchor so a $40,000 real price feels like a steal. Now here's where it gets interesting, because a college isn't really one business. It's at least two, smashed together and sharing a mascot. Business number one is the school, the thing you think of. Tuition in, professors, and buildings out. This business, on its own, at most universities, actually loses money, or barely breaks even. Teaching is expensive. Small classes are expensive. Tenured professors are expensive. Business number two is the endowment, a giant investment fund sitting next to the school that behaves basically like a hedge fund with a library attached. Elite universities have been collecting donations for hundreds of years, investing them and reinvesting the returns, compounding quietly since before the Civil War in some cases. Harvard's endowment is worth over $50 billion. Yale's is in a similar range. These funds are run by professional investment managers who put money into stocks, private equity, real estate, venture capital, the same stuff hedge funds do. And by law, nonprofit endowments only have to spend about 5% of their fund each year. So a $50 billion endowment might spend $2.5 billion. And if the fund earns 8 to 10% that year through investment returns, it actually grows while still funding the whole university's budget. That's the real business model at elite schools. Tuition is basically a rounding error next to what the endowment throws off. The school itself can be a low-margin operation because the investment fund next door is the actual cash machine. This is where people usually get confused, because college football and basketball look like massive money losers on paper. New stadiums, coaching salaries in the millions, private jets for recruiting trips. At most schools, athletics do lose money. Only a small number of big football programs are actually profitable on a pure accounting basis. So why do it? Because athletics isn't really its own business. It's a marketing and fundraising department that happens to play games on weekends. A winning football team gets a university's name on national television 15 times a year. That's advertising money literally couldn't buy at that scale. It drives up applications the following year, which lets the school be more selective, which raises its rankings, which lets it raise prices and attract better donors. Endowments are the real payoff. Alumni who feel emotionally connected to a school through sports give enormous gifts, sometimes specifically because the team just won a championship. A single successful basketball tournament run has been shown to boost donations and applications measurably the following year. Economists actually have a name for this: the Flutie effect, named after a Boston College quarterback whose famous last-second touchdown pass triggered a huge spike in applications the next fall. So sports aren't a business line. They're a customer acquisition and donor retention machine that runs at a loss, on purpose, because of what it buys elsewhere. Here's a group of students almost nobody talks about when they complain about tuition: international students. And they matter more to a university's bottom line than you'd think. Most international students aren't eligible for U.S. federal financial aid. That means they pay closer to the full sticker price, in cash, often up front. At a lot of public universities, this actually becomes the quiet backbone of the whole operating budget. Here's the mechanic behind it. State governments have been cutting funding to public universities for decades. A state school that used to get half its budget from the state might now get a fraction of that. So schools had to find a new revenue source, and they found it by admitting more full-paying international students, often at 2 or 3 times what an in-state resident pays for the exact same seat in the exact same lecture hall. This is why you'll sometimes hear about public university enrollment shifting to bring in more students from countries like China, India, or South Korea. It's not really about internationalizing the campus experience, even though schools will absolutely market it that way. It's about plugging a hole in the budget with customers who pay retail, because the in-state customers are paying a heavily subsidized, almost wholesale rate. It's the exact same trick airlines and hotels use. Fill your cheap seats with locals who need convincing to book at all, and fill the expensive seats with people who have fewer alternatives and are willing to pay more to get in. A university's admissions office, whether it admits it or not, is running a very similar kind of yield management operation. Now let's talk about maybe the strangest part of the whole system. For the most selective schools, saying no to you is actually part of how they make money. Normal businesses want more customers. A more selective coffee shop isn't worth more just because it turns people away. But universities are one of the rare businesses where turning people away is the entire point, because scarcity is what creates the value in the first place. Think about how college rankings work. A huge factor in most ranking systems is acceptance rate, how low it is. A school that accepts 4% of applicants signals something different to the market than a school that accepts 60%, even if the education inside the classroom is nearly identical. That low acceptance rate becomes a marketing tool. It gets covered in the news. It gets talked about at dinner tables. Parents assume the diploma itself must be worth more, purely because it was hard to get. So schools have a direct financial incentive to get as many applications as possible, even from students who have almost no chance of getting in, because a bigger applicant pool with the same number of open seats mechanically produces a lower acceptance rate. This is why elite schools spend enormous amounts of money on outreach and marketing aimed at students who will almost certainly be rejected. Every rejected application makes next year's acceptance rate look a little more exclusive, which makes the degree look a little more valuable, which lets the school raise prices and attract bigger donations from alumni who feel like they own a piece of something exclusive. Economists sometimes describe this as a positional good, something whose value comes not from what it does for you directly, but from the fact that most other people can't have it. A designer handbag works the same way. A university seat at a top 20 school, in a very real sense, is being priced and marketed like a luxury handbag with a library card attached. Here's another layer most people never think about. Universities are some of the largest landowners and landlords in their cities. Columbia owns huge chunks of real estate in Manhattan. Stanford owns roughly 8,000 acres of land in Silicon Valley, some of the most valuable dirt on Earth, much of which it leases out to businesses. That land alone throws off enormous, steady income completely separate from tuition or the endowment's stock portfolio. Then there's research. When a university lab invents something patentable, a drug compound, a piece of technology, the university typically owns a share of that patent, thanks to a law called the Bayh-Dole Act, passed in 1980, which let universities keep ownership of inventions made using federal research money. Some of the most valuable licensing deals in history have come out of university labs, and schools take a cut for decades afterward every time that invention gets sold or used commercially. So by the time you add it up, a major university's actual revenue is coming from tuition, priced individually per student, an investment fund, a real estate portfolio, patent royalties, and a fundraising machine disguised as a sports league. Tuition might genuinely be the smallest, least important piece of the whole operation at the most elite schools. This is the part that trips people up the most. So let's clear it up directly. Nonprofit does not mean a college can't make money. It means the college can't distribute profit to shareholders. There are no shareholders. There's no dividend check going out to anyone. But the institution itself can accumulate as much wealth as it wants, forever, tax-free on most of its investment gains. It can pay competitive, sometimes enormous, salaries to administrators and investment managers. It can build gleaming new buildings. It just can't hand out a check labeled profit to an owner, because structurally, there is no owner. This is actually a brilliant structure if you think about it from an economic angle. A nonprofit university gets the tax advantages of a charity, the fundraising advantages of a beloved institution people feel emotional about, and the ability to run investment strategies as aggressive as any Wall Street fund, all at once. It's not that colleges aren't businesses. It's that they're a specific kind of business, explicitly designed to never look like one. So next time you see a tuition bill or hear that a school is running a deficit, remember what's actually going on underneath. The classroom might be losing money. The football team is supposed to lose money. But the land, the patents, and above all the endowment are quietly doing the real work, compounding in the background for decades, sometimes centuries, completely disconnected from whether any given student's tuition check clears. Colleges figured out something most businesses would kill for: how to be priced like a luxury good, funded like a hedge fund, marketed like a sports league, and taxed like a charity, all under one name, one mascot, and one very convincing story about being for the students. If you want to see how this compares to how hospitals, another nonprofit that somehow builds shiny new wings every year, actually make their money, let me know in the comments. That one's even weirder. Thanks for watching. Subscribe if you want more of the hidden economics behind institutions we think we already understand.